Welcome to The Explainer. Today, we're jumping right into a massive anomaly unfolding in the global commodities market. We've compressed some recent, high-level data into a highly focused look at what, honestly, could be a historic shift in how silver is priced. Now, if you follow precious metals at all, you already know the official price is blinking on the screens. But there's actually a silent price war underway right now that threatens to upend that entire system.
Let's get right into it. Market data is pointing to a completely staggering disconnect. On one side, you have standard Western paper silver prices, but on the other side, there's this massive premium over in Shanghai, where physical silver recently traded at an unbelievable $73. Guys, this isn't just some minor blip. It's a flashing red warning sign that the official paper price might literally be losing its grip on reality.
Now, to really grasp why this is such a crisis, we gotta talk about arbitrage. Think of arbitrage as a mechanical bridge that keeps global prices connected. In a normal, healthy market, if silver is trading higher in Shanghai, big banks will just buy cheaper metal in the West, ship it east, sell it, and pocket the difference. Boom. That action automatically closes the price gap, keeping global markets perfectly aligned.
But here's the crazy part. Right now, according to the source material, that bridge is completely broken. That massive premium in Shanghai, it's persisted for days. Mechanically, this tells us something super specific. The physical metal either just isn't available in the West in the sizes they need, or the delivery risk is so incredibly high that putting it on a boat simply isn't worth the gamble anymore.
Before we crunch the industrial numbers, let's quickly take a step back and look at why a silver shortage messes with our heads so much. Check out this awesome piece of linguistic trivia. In French, the word for silver, argent, literally means money. You only know which one they mean based on the context of the sentence. I love that. It beautifully highlights silver's thousands of years of history as a rock-solid financial foundation.
But moving from history back to present-day mechanics, industry data reveals a downright terrifying bottleneck. Ready for this? Global manufacturing only holds a mere 5-week supply of silver inventory at any given time. That is absolutely nothing. Think about it. If there's a shipping delay or a major supplier even slightly pulls back, the entire global supply chain risks seizing up almost immediately.
And that incredibly tight 5-week buffer, it is facing an unprecedented squeeze. Exploding industrial demand is hitting it from literally all sides. We're talking about the tech you and I rely on every single day. Smartphones, power grids, AI data centers, electric vehicles which use up to a full kilogram of silver each, not to mention global defense manufacturing. The demand curve here is going absolutely parabolic.
To make matters even trickier, the analysis points out a huge mining constraint. We can't just, quickly dig up more silver. Why? Because roughly 70% of all silver globally is actually mined as a byproduct of extracting other metals like copper, lead, and zinc. You can't just flip a switch to meet this new demand. In fact, bringing a brand new mine online takes an average of 7 long years. So because of this severe supply crunch, the source argues that Shanghai is suddenly taking the lead in the global market. And it makes total sense, right? In a shortage, the market closest to the actual physical flow of the metal is the only one telling the truth. The physical market knows the inventory simply isn't there, so buyers are bidding accordingly.
So how does this whole thing spiral out of control? Well, the analysis outlines 4 specific mechanical triggers pushing these physical prices higher. Number 1, the Shanghai premium expands, basically proving the supply pipe is clogged. 2, in a thin market, even a few serious wholesale orders can wildly spike the price. 3, Western attempts to suppress the price via paper sales totally fail against real physical buying. And 4, physical procurement fear rapidly spreads through industries.
Let's zoom in on that 4th trigger for a second, procurement fear. This leads to what economists call inelastic demand. Imagine you're a solar company manager, right? You need 500,000 ounces of silver for a massive production run. If your supplier says the metal is extremely tight and the price is suddenly way higher, you don't argue. You just pay the premium. Losing a $50 million customer contract is infinitely worse than paying extra. You absolutely must have the metal.
The core crux of the argument presented in the reports is this. Decades of Western banks controlling prices via paper futures, like ETFs, options, and contracts, are now collapsing against the hard reality of physical delivery. When confidence in paper wanes, the market stops looking at the glowing numbers on the screen and starts asking one simple question. Okay, which exchange will actually let me buy and take home the metal?
Now, if Shanghai continues to force the issue, paper short sellers are going to be completely trapped. And rather than admit defeat, the analysis predicts institutions might just try to change the rules.
We could see them blame market speculators, invoke emergency powers, raise margin requirements to force liquidations, or even pause trading entirely. Actually, we've seen this exact playbook before, like with the Hunt brothers in 1980 or that massive nickel squeeze back in 2022.
However, the explainer strictly notes a glaring flaw in that strategy. Closing the casino doesn't stop the game, it just moves it to private networks and physical exchanges like Shanghai. While intervention is definitely a real threat, it's just a band-aid. Absolutely no amount of financial rule changes, margin hikes, or trading pauses can magically print the physical silver bars that global industries desperately need to function. You literally cannot print physical metal.
Which leaves us with the ultimate question posed by the source material. Are we currently witnessing the exact moment where undeniable physical demand finally shatters the illusion of paper pricing? If the West loses control of silver, the fundamental pricing structure for literally all commodities could be challenged. It is a fascinating structural anomaly to watch. Thanks for joining me on this explainer. Keep your eyes glued to these markets, and as always, never stop learning.